Hello everyone, welcome to our market outlook of October 2025. We are in conversation with Mr. Praveen Bhalera, Managing Partner, Pranitya Wealth. Let us hear about what his thoughts on the current market situation.
Yeah. So I think let's start with the global setup first. Again, that drives the market currently. It all starts with again Trump, and the tariff thing is not over. The new thing is now H-1B visa and the tariff on pharmaceuticals. See, there is a feeling that he's after India. So actually, that's not the case. The tariff on pharma is generic on all countries, and also H-1B visa is applicable to all countries, not specific to India. And why it is not specific to India, let me explain it in my further discussion. So H-1B visa, see, though India is a major beneficiary, and we have been holding substantial share of H-1B visa currently. He is keen on only getting skilled workers into US here on, and that will make it's like doing a value add thing in the
Correct.
manufacturing. If you had to penalize India, you would have charged this that one lakh dollar on all the existing even H-1B visa holders, but he has not done that. He has done only
New
incremental
applications. Yeah.
only. So I feel that's a country choice whom to allow, whom not to allow, and I don't see any. Of course, I don't see any big rationale behind it, neither any beneficial thing. So that see, in fact, the study says it will in fact help India. So we already are in the process of setting up GCCs.
Correct.
We already have 1600 GCCs, and we'll have more. So that will help most of the companies to readjust their employment base back to India,
India.
and only the meaningful people will remain offshore, and rest will be near shore, whatever we call. And we'll have more people staying into India. The Brendan is avoided. The charging will be in dollars from India into other countries. So it is seen in long term. It will only help India and not very detrimental to the large IT companies. Of course, there is a period of some adjustment will happen. Coming back to pharmaceuticals, I think it is very clear this will be on only branded drugs. When it comes to branded drugs, India just export $30 billion of branded drugs, and US, the total pharmaceutical market is about $2 trillion, of which 680 is US. So $680 billion is a huge US market. Of that, 56% of generic market is controlled by India.
Correct.
And of course, whatever we export to US, 95% is generic
Generic.
drugs, only 5% is branded. Of those branded also, if you see Sun Pharma and all, most of these companies have farm plants within US, and some are in the process, they can set up their plants within US in no time. So, and then some of these companies I see gone and acquiring some US pharma companies. So that will also help, resolve that pharma issue, and that's not going to be very significant. It comes to money for India. So as of now, we feel these two things is not going to hurt much. But yes, we have been debating that this will not hurt much, this that will not hurt much, and things are coming day by day or week by week. And I feel it has to stop somewhere, and there has to be clarity when it comes to trade.
So, sir, do you think that Trump's pain point is the Russian oil?
100%. I think it start with Russia. Actually, Russian oil, he in terms says he is fueling the war
War
there.
thing.
But the fact of the life that we can easily shift from Russia to other
Country.
US. Instead of $5 billion, we can buy 15-20 billion dollars from US. Uh, the Russian oil all started because of actually US, because they made us to buy from Russia to keep US inflation low. So in order to keep US inflation low, they said let oil be under control. So you also buy it from Russia. So that had happened in the last about 5-10 years ago when the Trump was not around. So it all started with US that everybody should buy Russian oil, and now they are again. So today you and us do buy Russian oil. You might stop, and
Correct.
you might indirectly pressurize us also to stop buying Russian oil. One need to see how this whole thing pans out. But the main fact remains the same. Like when China and India
India.
buying oil from Russia,
Will slow down.
if both of them stop buying oil from Russia, will solve the problem or will really make impact. Otherwise, not going to really make
Yeah. So
any
he
use.
wants to try to control the inflation.
So
Basically.
idea is to US inflation was the main idea to
Correct.
be controlled, and also the pharmaceutical. Just going back to that, he want overall cost of medicine to be lower in
Lower.
US,
Correct.
and that is how he want generic drugs to be
Correct.
more promoted, and he want also the American companies to do well. So that's a more main intention, and of course he need dollars in US. So
Correct.
that's what's the yeah.
Sir, how do you see Indian economy at this stage?
See, it has really come a long way. If you see from 21 till now, people see the current situation, but how much mileage we got, or how much mileage we got, how much area like recovery we have done from 21 is notable. Like just to see the GST number, GST has gone up by 94%. That is about 1.9 times. The corporate tax collection has gone up by 116%. That is 2.2 times from 21 to 25. The income tax collection went up by 143%. That is about 2.4 times. And corporate profits have grown by 136 times. That is again 2.47 times. There are 2.5 crores new taxpayers added in this last 4 years. Why these numbers are important? Because they virtually more than doubled. And you know, the underlying economy has to do well to double these numbers.
Correct.
So 15% compounded growth rate is what is implied
Yeah.
when I talk about these numbers. Secondly, last year FIs have withdrawn about $28 billion of, in calendar year, $21 billion. Besides that, we are still holding $704 of forex reserves. So forex reserves has actually gone up with this kind of withdrawal. RBI has gone cut rates. We are at 5.5%, lowest 100 basis point. We may not cut in October, but we might cut another couple of percent, 100 basis point going ahead. The GDP growth has been 6.5%. Last quarter was 7.4, 7.8. So that shows about 3-4 rating agencies, global rating agencies, has upgraded India rating of late. The balance sheets are very, very strong. The NPs are coming down. The GDP to borrowing, the gross borrowing to GDP ratio has significantly improved, mostly because corporates are not resorting to the bank borrowings, but they have this capital market open, IPOs. They're doing ECBs, and even they're doing the NBFC route. So all that has helped the GDP to debt ratio to improve overall. Inflation is under control, virtually 2-3%. Maybe because of this erratic monsoon, we might see some kind of a food inflation eventually going up. But in all, it is well within the RBI's comfort zone. The government efforts has been very, very remarkable. About 10 to 15 schemes are in the working to boost export, to boost production, PLI, the manufacturing exports, and all that is really helping corporate to manufacture more. The nominal GDP growth is expected this year to be around 10.8%, and corporate earnings is expected to be around 12%. So all that looks good today in the current environment, provided things don't go too murkier from now. The pain point is only the export part, though India doesn't form large part of the global exports. But as last last outlook we discussed, the employment in unorganized sector might be a problem for us, and some sectors might suffer because of the finding alternate export markets.
So looking at all the numbers, the economy is looking good, but I think everyone wants to know why the equity markets have not been rewarded so much for the past 12 months.
Yeah, like almost now September we peaked last high, and last 12 months has been really grind for Indian market. I think it all starts because of the valuation expectation. We started last year when we are not aware that there will be tariffs. There is going to be, or BJP is not going to be thumping majority. It all started with that, June of 24, if I am not wrong. And post that, we had 4 or 5 instances where market has gone up and gone down without direction. So there is a completely we never estimated earnings to be that low. So we always started here with 15-18% of earnings,
Correct.
and we ended even last year with single digit number 8-9%, and that's a expectation mismatch, and we at an elevated level with the expectation. So this is a kind of a time correction we are in. Like
Okay.
you've seen, market is going to 25 200 and on the downside 24 200 and not able to break that convincingly. The last peak was achieved in September 24 of 2024,
Yes.
and that was 26,200. We never there. So that it start with that. Secondly, we see a lot of FI been withdrawing money
Withdrawing money,
relentlessly. Every like 2.6 lakh crores in last 1 year
1 year.
is a mind-boggling number. If there was no support from local money, would have been down like
Difficult.
anything at this stage. Why they are withdrawing money? They have their own reasons. They are
Yes.
withdrawing money because their jobs are in threat. They don't know what is happening in the emerging markets. They don't know the effects of tariff. They don't know what Fed is going to do. How US will they face inflation? Will they face any kind of a recession? They are not really aware. So today the first trade is to go back to the own currency.
Yeah.
So they are getting redemptions.
haven.
Not that they are only selling in India. It's a game. They are redeeming from emerging markets and going back to US or whatever the local currency or local home country.
Correct.
That's the trade. So the FI is to blame.
Correct.
Secondly, if you see our currency, it's a dichotomy, like currency and FI withdrawal. It is the currency is also not very stable. We actually depreciated against all currencies, worst emerging market currency last year.
Yes.
Even our depreciation against euro, yen, and pound is much larger and harsher than what we depreciated against dollars. So all that instability and uncertainty about currency led to a lot of withdrawals also. We are predominantly India is a consumption economy. So India is most important thing for India is wages, consumption, and a private capex. I think all three are under pressure at this stage. And if you see wages, say 2020 post COVID, we've seen a growth rate of wage growth of 10 to 11%. And last 2 years, we've seen growth of only 6 to 7% in terms of wages. Private capex is not happening, but natural because capacity utilization is around only 75%. So there's no, so government is doing the main heavy lifting and they're doing the more spending on the capex. And consumption is, either supported by either rural India or urban India. But now this year, I don't know, with the heavy rains around, how the rural India will support the consumption. So that's a question mark. So consumption-led economy usually have a problem of, we no exports and we depend only on the earnings left in the hands of the investor or the consumer to spend. And that is how government has gone for a GST cut, because that's the only way of leaving a lot of money in the hands of customer to spend. How it works now is to be seen. Post Diwali last, like Q2 or Q3 of this year, we'll get to know the real impact of this spending. Then third is valuation. If you see the composition of index or Nifty for that matter, mostly it is a banking. Like banking finance comprises of 35% of the Nifty. Today you see valuation of HDFC Bank or ICICI Bank, it's all-time low. Valuation I'm saying. They're trading at 15, 16 times. We never traded at this level. Why this is happening? The overall, if you've seen in last 1 year, the corporate, as I discussed, the corporate credit offtake is virtually not picking up as the way it is expected. Thanks to, first of all, the internal accruals, they have enough money. Second could be the capital markets access to IPOs, the way the response is given to the IPOs. Third is ECB, which is much cheaper outside to borrow. And last could be NBFC, that is the fastest way of borrowing money. So all that has led to people not approaching banks for lending. So banks in turn has gone and done lending to personal loans. So last year NBFC ratio, NBFC had lent 27% of their book to personal loans. This year it has gone to 41%, and similarly is the case with the banks. So people are afraid that the delinquencies in personal loans are much
Much
higher than the
higher.
corporate loans.
Right.
So these private banks and rest of the even PSU banks for that matter are trading at a lower
Lower rate.
ebb of their valuation
Got it.
just because of fear of the defaults and
Correct.
delinquencies. Otherwise, I don't see any reason. And of course, the growth has not been that great. And growth is considered to be a corporate loan growth, which is more important
More
than the
important.
personal loan
Which
growth.
has not
Yeah.
taken uptick.
It has not taken up. So that is the reason the Nifty with banking as a major weight
Yes.
is not able to move up,
Move up.
the
Yeah.
way it is expected. IT was another sector which has been
Correct.
affected. So if you all all this put together,
So all the heavy lifters have not actually
they will
contributed
not
to
be
the,
able to
yeah.
move the Nifty up. So that's market is stuck in a range, and unless capacity utilization goes up, and service sector, which is the dominant part of our
Correct.
economy, which 56% of our economy, and about $180 billion. So that has to create more jobs, and manufacturing has to really take up the major share of the services
Correct.
out from the GDP. That is how the country will, the
Improve.
markets will start rewarding companies, and the earnings growth will eventually go up.
Sir, why do you think that rupee is depreciating?
I think it's interesting. If you see dollar, of course, it is depreciating against the dollar, and we are depreciated against the rest of the currencies, as I told you. I think major reasons I see is FI withdrawal, and see, we import as a country import a lot of gold, silver, and oil.
Right.
And when you are importing, naturally there is a pressure on currency. Secondly, the ECB also is very popular amongst the corporates. So because of this, I think the dollar is under pressure. But that will, I think, we can, if you see the ERR, that is comparative valuation of rupee, we are still undervalued. So there is scope for us to depreciate further. I think I'll not be surprised to see 89 to 90 in next few days. But in long run, it is expected that dollar will depreciate against all other currencies because of the US might face kind of a recession, or they might hit by some kind of inflation soon. So that's a view currently on the currency.
Sir, how do you think the Indian markets will react going ahead?
See, we are, as you know, market doesn't like uncertainty. Today we are in an uncertain phase as to the US tariff. We are not really sure how this is going to end. So FI selling has been quite alarming. That has to stop for market to stabilize somewhere.
Correct.
There is enough internal liquidity. Look at response to IPOs.
Correct.
So liquidity wise, we don't see any issue when it comes to India. Secondly, the valuation part also has been addressed to a certain extent, because with the recent sell-off, the
Yeah.
valuation has corrected. Though I'm not saying it is attractive, it is reasonable at this stage. Just
Correct.
to look at Nifty 100, we trade at now 21.3
Okay.
times. That is about 3.3 times the
Fair
book.
enough.
The mid cap trades at about 31.2 times, which is about 4.5 time book, and small cap is around 31.5 times, which is around 3.6 times. The returns which people generated, or invested returns they got last year, was a bit of a disappointment who has joined this party of late, because last year large cap lost about 4.5%,
Correct.
mid cap lost about 3.5%, and small cap about 7.5%.
Correct.
That's a number people have seen when they started investing last 1 year. Mind you, the NSE latest number showed they added about, they have now about 12 crore unique investors with them. So that means 12 crores investors are really investing in stock market, and mutual funds say they are about 8 to 9 crores of
Crores.
unique investors. So I think that number is around 12 crores for sure, who are addressing the equity market, which is close to now 7-8% of the population. So this number eventually will go up. So what I see from here, he will be in a range for some time, some more time. We have to spend this 24,200 to 25,200 range.
Correct.
And to break out of this range, we need good results either from Q2.
Correct.
The result season will start soon. But till that time, I think directionally there is no clue. I don't see results will prop up this thing to re-rating stage.
Correct.
We already re-rated, we are already at a fair valuation.
Correct.
So from here to go up, we need some kind of a very strong reason for market. So it could be a end of tariff war by Trump or India.
Correct.
We don't know how this is going to end. Nobody has any clue at this stage, at least. And uncertainties in terms of war, tariffs, the currency has to get over. Fortunately, oil is under control. Oil will remain under control for India. I am not worried about Indian growth rate itself. So we will
Correct.
grow at 6.5%. It is confirmed by so many agencies. We fortunately are a domestic economy. So internals will only grow as the time passes.
Correct.
Some kind of an impact of exports is bound to be there, but over a period of time, I think it will get compensated through other factors. That's what we feel, and that's how people are even confirming 6.8 or 6.5% GDP growth for India, even going ahead. So I see one has to really stick to the investment we are done, not get panicky. Investment is about we can say patience. You know, there is a jungle, you get lot of photographers, amateurs comes and goes, but the guy who is from National Geography will wait for the right shot. So
Correct.
somebody has to be a lot of patience to get that right shot, and right shot only come with the time. So I feel stay invested, fresh money. We can go in tranches,
Correct. Maybe
not at
STP
one
route.
go, and because one go, there is no reason for to put one go today. As we see, because there's no drivers. For market need drivers, so don't see any drivers at this stage. And drivers, where it will come from, nobody knows. When you expect the least, I think market has given good returns.
Correct.
When you expect more, and that's a
Market
disappointment we
has
get.
disappointed.
Yeah, that's what I feel.
Sir, your view on liquidity and the debt market?
Yeah, if you see last month, yields on debt market shot up, like 10-year gone beyond 6.5, it went to 660. All that happened because of the decision on GST. When the GST rate rationalization came in, everybody thought government will overshoot the borrowing program. So everybody was waiting for second half of the borrowing numbers. They came in last week and they came as a surprise. So actually, 6 lakh and all crores will be borrowing less than last year. So that fear of fiscal prudence, discipline, deviation is gone. So now yields should slowly come off. Last one month return on arbitrage is close to 9 to 10%. So all that has happened over a period of time, and liquidity also was scarce. Why liquidity was scarce? Because dollar was appreciating against rupee. RBI has to intervene and sell dollars. We call it a rupee sterlization or dollars, whatever you call, rupee or dollar sterlization. So what RBI do? They sell dollar to the banking system and take the rupee out of the banking system. By doing this, they created indirectly some kind of a liquidity issue in the banking system, which is a bit of a artificial in nature. And that is how the yields on short term has risen to a sky level. And that's how you see arbitrage went to 9 to 10% in the last week of September. But all that will settle down eventually. The RBI will make sure liquidity is enough. We had defended rupee to about 88 to 80 and not gone beyond 89. Secondly, the dollar reserves is intact, about $704 billion. So I feel liquidity wise things are comfortable again. Yields should again on debt side go down. This actual offer and great opportunity to lock in your money in debt.
Correct.
There are few products on debt side one can look at. I don't want to waste time by recommending products at this stage, but debt has to be integral part. I spoke last my outlook also, and this outlook also I emphasize allocation to debt is imperative. Yield, bond yield, and equity yield. Today, actually, bond yield is cheaper than equity yield. So it's make more sense to allocate money to debt even at this stage. Yeah.
Sir, what is your take on the current commodities like silver and gold? Will they further seize any up move?
Yeah, we spoke about silver and gold even last time, and we gave a target of 1,50,000 crore for silver. We never thought it will get achieved in a 1 month time. So we are already at 1,40,000, 45,000 lakh
Right.
for 1,45,000 at silver, and gold also is hitting a new high. So 1,14,000, 15,000. So see, this will continue for some more time. Of course, one has to be very sacrosanct of the fact that there is a much of an investment element involved today than the
In the
actual
previous days.
usage.
Yes.
So a lot of investors, speculators enter or traders have entered this market of gold and silver. Who will take the money out from the on the table? We don't know. Any trigger can, make huge correction in those two commodities. So beyond 1,50,000 in terms of silver, or 46, 40 dollar for silver, one has to be very, very careful. Secondly, on gold, also keep eye on what China and India or the central banks are doing with gold. Are they back to dollar, or are they still buying gold? Need to be watched for your view on the gold. So it's a just a demand and supply equation according to me. But we don't see any stresses at this stage for this commodities to correct short term at least. So one can still hold in the portfolio.
Sir, what are your final thoughts to conclude?
Okay. So currently, my market is surrounded with a lot of fear. People are worried about deep correction, the tariffs, the uncertainties, and all. One thing I can tell you from my 35, 40 years of experience, when the internal are factors or internal the macro factors in the economy are strong, I don't see they are deteriorating overnight. So 6.5% is again we are the fastest economy in the country. We are already third largest economy in the world. Uh, all that will make short-term blip or short-term correction, which we are seeing in the market. I don't see any reason why we should go below 24,000. I'll be surprised. There has to be very, very strong reason for us to go below that. That reason at least is not present at this stage as we speak. I feel this tariff war will end with some kind of a compromise. I don't know whether we'll end up buying more oil from US slightly and cut down from Russia, or we might buy some, like the corn which has been pushed on us to certain extent, and it will be kind of some kind of a give and take. I believe in every deal we have to have give and take, and that only the time is a factor which is creating trouble at this stage. So somebody has cash or the liquidity and time on hand. I think this is the best time to pick up the good stocks at the right nice valuation and create a long-term portfolio for yourself. This time will go and you will forget all these stresses and this kind of a situation which we have faced. The returns on equity never comes in linear manner. Everybody, long-term investors are aware of it. After 5 or 4 years post-COVID, the compounding of equity is still at 14, 15, 16%. That
Right.
cannot be forgotten. And we have seen a lot of wars, a lot of ups and downs in the economy in that last 4, 5 years. I think any investment in or anything more than the risk-free return, one has to assume some kind of a risk and allow some kind of a time for things to mature and things to materialize. So my request to investor will be stay put, invested. If you are afraid, don't put more money, but don't take out at least. So and see that you are in a quality stocks, you are doing sector rotation, or you're in mutual fund for that matter, which is the easiest way of investment. Lastly, we'll make a special session on SIF, which is a new vehicle which has come very, very handy, very, very useful for many of us as a new investment avenue. We might do a separate session on that. We are circulating note this week on SIF, and we request you to go carefully. There are a couple of funds already launched. We have used it ourselves,
Yes.
and we'll urge to go through that note and then attend the session, which we'll do soon. Thank you so much.